Holistaplan presents Tax Time with Jeff Levine. Let's talk taxes.
Hello everyone, Jeff Levine here, and it is great to be back with you once again. With our time together today, thought we'd spend some time talking about the net investment income tax, the NIIT, sometimes called the 3.8% surtax or the additional Medicare tax, sometimes called the Obamacare tax. This is that credit that was created out of the ACA and was first effective back in 2013 on the investment income of individuals. And when we're looking at what income qualifies or was potentially taxed under this surtax, we start with investment income, so things like interest, dividends, capital gains, etc. Also throw in there rents and royalties, income from passive businesses as well. So these are all types of income that could be hit with the 3.8% surtax. Now, as we sit here today, income from things like wages, self-employment income, S-corporation profits, those are all exempt from the net investment income tax, although there is some discussion over whether that could change for 2022 and future years. Now, not all individuals are subject to this tax. In order to find yourself subject to this tax, an individual does have to have modified adjusted gross income in excess of $200,000 for single filers and $250,000 of MAGI or modified adjusted gross income for married couples filing a joint return. So now that is, so that's a significant amount of income, but only investment income. It's actually the lesser of the total investment income an individual has, or the amount of income that is in excess of the threshold that is ultimately hit with this surtax. So if we imagine an example of an individual with, let's say, $220,000 of regular income, let's say from earnings, etc., and maybe they also have $50,000 of interest and dividends and capital gains investment income. So they have a total of $270,000, the $220,000 of regular earnings and the $50,000 of capital gains income, etc., the investment income. Well, as a married couple, if we assume they're a married couple filing a joint return, they would have a $250,000 threshold. So we look and we say, what's less? The amount of income they have over the threshold, in this case, $20,000, right? Or the amount of investment income they have, which in this case is $50,000. Well, naturally, $20,000 is less than $50,000. That would be the amount that gets hit with the net investment surtax. But what if they had regular income, let's say earnings of $270,000, and then they had the $50,000 of investment income? Notice that we didn't actually add any more investment income here than in our first example, right? $50,000 in both cases. But now, because their other income was higher, the net investment income is all over the threshold, right? They have $320,000 of income here. That's $70,000 over the threshold, but they have $50,000 of investment income. The lesser of those is $50,000. So despite the fact that I didn't change their investment income, more of it got hit with the surtax. And this is one of those surprises that catches clients and sometimes their financial advisors and even CPAs when they're doing things like Roth conversions, for instance. They look and they say, well, we only have, we're only adding ordinary income, so therefore we don't have to take into account the impact on the investment income tax because we're not adding investment income. Well, that's not entirely true. Have to be really careful of the crossovers between different types of income. And that's a common thing we see on returns. So it's critical to identify this type of thing, and the best way to do that is with tax projection software. And you don't have to worry about knowing all the thresholds and knowing what type of income is this and where. You just put in the numbers and let the software do it for you. That's how that's how financial advisors should do it. That's how CPAs who spend their lives pouring through the code do it. They look at the software, right? And they look at the output. So a tool like Holistaplan can give advisors a real edge here in that they're able to potentially use this. They're able to identify these sorts of side effects, if you will, of intended actions before they can actually create that side effect, which sometimes is worse than the effect itself. So with that, I'm going to turn it over to my good friend Ben Birkin, who's going to share some examples here of how the Holistiplan software can help advisors identify where the 3.8% surtax kicks in and how it works when you add new income, let's say so from a Roth conversion and so forth. With that, over to you, Ben.
Thank you, Jeff. This is Ben Birkin, Vice President for Customer Success and Engagement here at Holistiplan. And we're going to use Holistiplan to talk a little bit about how you can use this tool to talk to your clients about the net investment income tax, or the NIIT. I've created a scenario here where we've got a client that has adjusted gross income of about $255,000, almost $256,000 for married filing joint individuals, which means that they're going to be hitting the NIIT, right? They've already exceeded that $250,000 threshold. We've also got investment income of at least $90,000, right? This is $90,000 of long-term capital gains and qualified dividends. There's actually more investment income in here, but I intentionally created a scenario where the two items that you need to know about for the NIIT are far apart from each other, right? Because the NIIT is going to be applied, like Jeff said, to the lesser of investment income or the amount that you exceed the threshold. So in this case, we only exceed the threshold by about $5,600, which means if we're looking at this as a, say, 2020 return, they would have paid about $219 in net investment income tax. Not very much, because they're not over the threshold by all that much. So this is looking backwards, though. Thinking about looking forwards is a really nice way to visualize the impact of adding both additional ordinary income and investment income to your client situation, and how that's going to be impacted by the NIIT, or how that's going to impact the NIIT is a better way of thinking about it. So I'm over here now in the range calc screen, which we get to through our scenario analysis tool. Same basic underlying fact pattern for this particular client. And we see that with here, the range calc is showing us the impact of adding additional increments of $1,000, both for ordinary income, which is the screen that we see here, and long-term capital gains, which we'll scroll to in a minute. And what we see shouldn't be too surprising, right? We're already over the threshold. So adding additional amounts of ordinary income as it relates to the NIIT just means we're going to keep increasing the amount of NIIT that we pay, right? If you're already over the $250,000 threshold, adding more income means you're still going to be subject to the NIIT. But then you hit a spot where if you look at it and you're thinking too quickly, it might look like here, the NIIT disappears. Now, that's not really what's happening. What's happening is that at this point, which is roughly, we'll call it about $120 some odd thousand of additional ordinary income, we've hit the crossover point, right? We've hit the crossover point where the investment income is now less than the amount that we're over the threshold, right? You can think about that as you're going along this axis, the difference between the two is going to get down, 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 to a point where they're going to be equal. And then at some point, the lesser of the two is going to switch at this crossover point from being the overage to being investment income. And that's what you see happening right here. And what this means is not that the NIIT disappears, but that adding additional ordinary income is not going to be subject to the NIIT, because we've already hit the point, because we've kept investment income static, that all of the NIIT is going to be applied to that investment income. Now, it's going to be a little bit different if you're adding long-term capital gains, which is the other item that we've got down here. Why is that? Well, by definition, if you're adding long-term capital gains, you're also increasing your modified adjusted gross income. So no matter what you do, if you add additional capital gains, that by definition, you're going to have to be paying the NIIT along the way too. So you don't see that same crossover point because you're already there. So sometimes this can be a little bit confusing within the range calc screen. So we've got a little tool here that says, hey, what does it mean when I see the net investment income tax in brown on my ordinary income? And here it is. Here's the description. Basically what I just said, written a little bit more clearly. But we want folks to be able to understand this and be able to relay it to their clients. Thank you so much for watching, and we look forward to speaking to you next time.